Good morning.
Hi, good morning, Carrie. How are you?
Okay, how are you? Wait,
All right, I am looking for our PowerPoint here.
wait, hold on. I gotta get my notepad.
Here we go. Notepad in place, huh?
Yes.
All right, share the screen. Okay, we're up to chapter 13, huh?
Right.
We skipped number 12, which is about journals,
Special.
because we have other classes that are nothing but about journals, specifically QuickBooks.
Uh-huh.
So, okay, accounting for merchandise inventory.
Yep.
We're getting toward the end already, huh?
Yeah. Do we go back to chapters 9, 8, and 7?
Yes, absolutely.
Okay.
We end up with chapters, the last two chapters we do are on payroll,
Okay.
chapters 8 and 9. Chapter 7 is on cash, bank reconciliations, things like that.
Yeah.
We're going to continue with the world of merchandise inventory, okay?
All right.
Now, up to now, when we've purchased something, we debited purchases, okay?
Mm-hmm.
That is now changed. Now we're getting into more of a perpetual system where we're going to be debiting merchandise inventory. Purchases are a cost. Merchandise inventory is an asset, okay?
Mm-hmm.
And we're going to keep track of that asset all the time. Explain the impact of merchandise inventory on financial statements. Let me just see something here on financial statement. I guess they're talking about the errors.
Mm-hmm. Mm-hmm.
Errors in inventory will cause errors on the income statement, statement of equity, balance sheet. I guess that goes without saying, okay? If you
Mhm.
fail to count something or you overcount something.
Right.
If you understate the ending inventory, this will be a little bit important as we go along today. If you understate the inventory count, in other words, you forget to count something,
Mm-hmm.
you forgot to count that $10,000 box of goods in the corner there. You didn't see them, okay? By failing to count that, you have understated your net income.
Mm-hmm.
Understating an asset will understate your net income. All right.
Mm-hmm.
We just have to kind of understand that.
Got it.
If you overstate an asset, it has the opposite effect.
Right.
But even more germane than that is if you forgot to count some goods this month, you're going to mess up next month automatically
Right.
because you're going into the new month with the wrong beginning inventory, right?
Right.
You failed to count it properly this month, so you're starting off the next month wrong. So a mistake made in January affects January and February. You'll be understated in January and overstated in February, okay? And obviously that can cause disastrous results. Let's just take a quick peek here. They're showing it done correctly, okay?
Mm-hmm.
The ending inventory was 20, and that's what they counted. So they came up with a net income of 30 and 30, right? You see where I'm pointing there?
Yeah.
Okay, so they did things correctly. They counted 20, that's what was there, $20 million, it's a big company. And the beginning inventory in the next period was 20, so everything's good.
Yeah.
But look what happened here when they understated. They understated. By understating it by 5, they understated the net income by $25. Because what happened was by understating it, you're telling your system that you sold it when you really didn't.
Right.
Okay. So you understated the count and you were thus $5 understated in the month of of year one or month one, and then look what happened the next month. You're overstated $5.
Right.
Okay, so that's
Right.
the concept we want you to grasp. That
Okay,
if you
so just say that happened. Say it was supposed to be 20, but you put 15 instead. And then the following month, would you then put 25?
no, the following month you have to start with what's on your financial statements. You have to start with the wrong number.
Okay.
We're
So-
finding we're finding these errors well after we publish the inventory.
Right. Okay. So, wait, can you go back a sec?
Yeah.
Okay. So you're still like, so where is the error? So you said 20 plus 40 is 60. And then where did, oh, so that's just you count the merchandise there. Okay.
Yeah.
Got it.
Yep. So we're understated by 25 here and overstated here. Now, if this was a big company with a big number,
Yeah.
say that was a $5 million difference,
Yeah.
the boss might say, holy Christmas, I got to lay some people off. We're doing poorly.
Right.
You can see how these would lead to bad decisions.
Sure.
And it screws up your statement of equity as well as the balance sheet.
Mhm.
We're talking two different systems, okay? The periodic and the perpetual. The periodic is what we've been working on ever since we started this class, okay?
Mhm.
The periodic assumes that you have to take an inventory at the end of the month in order to capture your cost of goods sold and inventory balance.
Mhm.
Under the periodic system, when we sell something, we debit accounts receivable and we credit sales. And that's all we do. Under the perpetual system, we know every second of every day exactly how much we have in our inventory of every item, because we're keeping track of it with every sale.
Mhm.
Under the perpetual system, you have the same entry where you debit accounts receivable and credit sales, but you also have the second part of that entry, which is to record the cost of goods sold with a debit to cost of goods sold and a credit to merchandise inventory. Okay.
Yeah.
So the periodic system, merchandise inventory, the balance in that account is always going to be last year's physical count. It's always going to be whatever the most recent physical inventory was.
Mhm.
Purchases account for all merchandise purchases. You're putting them into a cost. Merchandise and cost of goods sold are only computed at the end of the year or the end of the month. Under the perpetual system, the merchandise inventory account reflects what you actually have currently. You're debiting to merchandise inventory and cost of goods sold is credited to merchandise inventory, right?
Mhm.
You debit merchandise inventory when you buy it and you credit merchandise inventory when you sell it. And under the perpetual system, hopefully there's no need for end of year adjustments if the physical inventory agrees with the amount reported in the merchandise inventory. Now, in reality, where I worked for a number of years downtown Los Angeles, we had a perpetual, but what we did every day was cycle count. We had like 10,000 items in the inventory.
Yeah.
We would select maybe just three or four, two high dollar items and two low dollar items. And I would chase somebody from the counting out into the factory to count the stuff. And we
Wow.
would compare those four counts to the perpetual. And as long as those counts agreed, we knew we were probably okay. If one went off one day, we tried to find out why. But if we were back in gear the next day, we just called that noise in the system and we're still okay.
Hmm.
Under the perpetual system, you might not need to take a physical inventory at month end, okay?
So, and how is that accounting for the inventory happening? So you're selling goods, and then in the periodic system, you wait till when? The end of the month or?
The end of the month, yeah. You wait till the end of the month. And then the only way you're going to get the cost of goods sold is to go out there and count the inventory.
Okay, so but with the perpetual, you're counting every day?
You're not counting anything. You're recording the units as they go in and out. Which
Okay.
is on an online basis.
Okay, so Oh, because it's online, you said.
Yeah,
Okay.
yeah. Well, yeah, what we're saying is under the perpetual system, when you hand your credit card at Costco and they swipe when you bought those 4 televisions,
Yeah,
as soon as they swiped the card, I'm sorry, they debited cash and they credited sales, but they also credited the inventory for the cost of those 4 televisions,
right.
debited cost of sales. Periodic is old fashioned. I don't think anybody really uses it that much because you have all kinds of nice computer systems for small businesses.
Right.
Like you're using QuickBooks, for example, which is the sine qua non, as we say in Latin. So under the perpetual, you don't need to do those transactions. You do
Okay.
need to check the system once in a while. I'll tell you one story about inventory. October 1st, 1987 was the day of our annual physical inventory. And it took about a weekend to prepare for it, putting the tags out, you know what I mean?
Mhm.
Assigning the teams, who was going to count what the procedures are. We had a couple of big shots for some reason come out from Newark, New Jersey, the home office, to observe this inventory. They really just wanted to come to California, really. It was just a junket. What I'm getting at 7 minutes before the inventory was officially to begin, our factory was demolished in the Whittier earthquake.
Oh my gosh. Wow.
The building started shaking, and everybody and 2 guys from Newark go, "What do you do now?" And I said, "Follow me." And we ran out, which is not what you're supposed to do, but we did.
I think it's best to be away from where things can fall on you.
Yeah, we got outside. So
Okay.
we ended up having to go to another building eventually.
Wow.
Types of inventory systems. Now, this is a very important grid here to have in front of you when you're doing your homework, because what this thing does, Carrie, is delineate between the 2 systems in terms of journal entries, okay?
Right.
Periodic, this is what you've seen, purchase merchandise on account, right?
Mm-hmm.
Periodic, we're calling it a cost. It goes into cost with purchases, credit accounts payable. On the perpetual, you're debiting merchandise inventory, okay?
Mm-hmm.
You're putting it into inventory. You have a freight charge. Under periodic, we debit freight in. Look what we debit for freight under the perpetual. We add it right into the inventory cost. You see that?
Mm-hmm.
Now, here's a key difference right here that we've just been discussing. Sold merchandise on account, the cost of that merchandise was $50. Periodic system, we record the sale. That's the same between the 2, but notice the extra step in the perpetual. They're actually recording the reduction of the inventory and debiting the cost of goods sold.
Okay.
So on the perpetual side, they know exactly how much is out there because they've recorded the reduction of the units.
Mhm.
We're not doing that with the periodic. If you call a store that is on a periodic system and you say, "Do you have 6 of these products available, please?" They might have to put you on hold while they go back out into the warehouse and look.
Right.
Under the perpetual system, you just push the button for the part number and it'll pop right up.
Right.
Okay.
Right.
Merchandise costing $10 was returned. Notice the difference. We're both going to debit accounts payable because we no longer owe that money, right? We're returning the goods.
Right.
Under periodic, you credit purchase returns and allowances. Under here, you credit merchandise inventory. Another way to present this, Carrie, is where you see purchases under periodic, change it to merchandise inventory under perpetual.
Got it.
Okay.
Mm-hmm.
What else do we have here? Somebody returned goods to us. Somebody returned goods that cost us $15, but we sold it for $20. Well, sales returns and allowances and credit accounts receivable are the same under both systems, right?
Mm-hmm.
But once again, we are putting this inventory back into our records. We're debiting merchandise inventory because the goods were returned to us and they're still sellable. So we debit merchandise inventory and credit cost of goods sold to reduce it.
Got it.
Make sense?
Yeah.
And then you paid for merchandise costing $100 with a $2 discount. Again, this one we already know. We debit accounts payable and we're only paying $98, right? Because we took the $2 discount.
Right.
Again, notice what's one man's purchase discount becomes a perpetual's merchandise inventory.
Hmm.
So on the perpetual side, everything is debited to merchandise inventory. On the periodic side, your input, your products being delivered are debited to purchases, okay?
Got it.
So there'll be questions on the test about the difference between the two methods, okay?
Mhm.
Compute the costs allocated to the ending inventory and the cost of goods sold using different inventory methods. To determine the cost of goods sold, we need to know the purpose of a physical inventory. I think we know that to find out what's out there. Special calculations used under the periodic and perpetual system and the rule of lower of cost or market. Okay, let's take a deep breath and see what they're talking about. Take a physical inventory. Under the periodic system, you have to do it because you use it to allocate the cost between sold and unsold. Remember, we had a beginning inventory plus purchase number one, purchase number two, purchase number three. We add up those 4 items and we get what's available. Remember that?
Uh-huh.
What's available, we then subtract the physical count from that, and that becomes what we sold. The perpetual system, we compare to the accounting records to determine if the amount of merchandise actually agrees. Frequently done after regular business hours. And some companies are in a position where they can do it when the quantity on hand is low. You know, maybe a store like Nordstrom's, they might take their inventory, I don't know, at the end of January or something like that, after they've sold a bunch of stuff in December. Did you ever walk down the street and you see a store open late at night and you see
Yeah.
people in there with tags?
Sure. I used to do that.
Yeah, it's a real pain in the neck job, to be
It
honest with you.
is. It is.
There's an inventory sheet. We counted so many of these. Let's talk about this again, okay?
Yeah.
Goods held on consignment. Consignment, you familiar with that word, consigned
Yeah.
inventory?
Do people do
Yeah.
that anymore?
Oh, goodness, yes. Yeah, yeah. You walk into Nordstrom's or you walk into Macy's and you see those women schlepping bottles of perfume.
Yeah.
Those perfumes have been consigned to them by Chanel, say, okay?
Hmm.
Consigned. That means that Chanel gives them to Macy's to sell. It's not Macy's product to count in their inventory. It
Okay.
belongs to Chanel. So the deal is every time Macy's sells a jug of perfume,
Mhm.
Macy's must pay Chanel for the goods. Maybe that's $50.
Mhm.
And Macy's maybe sells it for 150.
Mhm.
And that's how they satisfy the arrangement, okay?
Mhm.
The consigned goods belong to the people who sent them there, the consignor, okay? So when you're counting a physical inventory, if you're the type of company that has consigned goods outside, you got to have somebody travel and count that stuff there, or trust the count you're getting from the store, okay?
Right.
We already talked a little bit, didn't we, about FOB?
Yes.
Yeah, the point in time when title changes to the goods, kind of an important concept, huh?
Right.
FOB, shipping point, the buyer owns it as soon as it leaves the warehouse. As soon as it's on the road, whammo. Buyer's responsible, he must pay the freight. FOB destination, the buyer said, I want nothing to do with it until I get it in my office.
Right.
And you could have arguments over these two FOB choices.
Hmm.
A little bit of strategy involved. Inventory cost components, proper cost must be assigned to the inventory. Cost means all necessary and reasonable costs incurred to get the goods to the buyer's place of business. And what they're saying, Carrie, is the cost components of inventory can include, of course, the purchase price. We're going to add freight into it. Maybe we had to have insurance to bring it across the country.
Hmm.
Maybe some kind of delicate stuff. And we had an insurance policy just to cover the trucking coming across the country. That would be part of the purchase price and
Right.
any storage fees, okay?
Yeah.
Computing the cost of identical items are purchased at different times at different cost per units. Now we're gonna have fun. Of the goods available for sale, how do we decide which units were sold and which remain on the shelf? We're gonna go through 4 different inventory methods of calculating your cost of goods sold and calculating your ending inventory. FIFO, LIFO, weighted average, specific ID. Are you ready?
Yeah.
I'm going to start with FIFO. Hold on. Let's start with FIFO. It's an acronym that means first in, first out.
Mhm.
We are pretending, and I use the word pretending deliberately, we are pretending we're always selling the oldest goods first, okay?
Uh-huh.
We're making that assumption. It's probably true, but not necessarily. Whenever possible, a business will usually attempt to sell the older goods first, like a grocery store, a bakery. So
Right.
FIFO sometimes follows the movement of the physical goods, but not always. Okay,
Mhm.
so let's look at FIFO. We have a beginning inventory of 40 units. You see that?
Yep.
Plus purchases of 60, 80, and 20. That brings us up to 200 available for sale. Okay,
Got it.
200 available for sale.
Mhm.
How many did we sell? It turns out we sold 50. That's what they seem to be telling us over here, okay?
Uh-huh. Right.
50. Or rather, they're saying there's 50 left in the ending inventory.
Oh, okay, so you sold 150.
Yeah, we sold 100. Looks like we sold 150. This
Right.
isn't as clearly presented as I want. Let me
Mhm.
take it through it this way. Your cost of goods available for sale is the total of all these, right?
Uh-huh.
What was our cost of goods sold? You have a piece of scrap paper in front of you, Carrie?
Yeah.
We sold, which ones did we sell under FIFO? We sold 40 times 62, right?
Right.
We sold 60 times 65. That's
Mhm.
100. And we sold 50 out of the third level. 50 times
Wait,
62,
no, it says beginning inventory was 40 and then the first purchase was 60,
right?
right?
Right. And we sold 150. Okay.
Okay. Well,
So
what-
go ahead.
okay. So when it's saying first purchase, are you purchasing more inventory? Or
Yeah.
you,
At the beginning of the month, this is history now. We're
okay.
now at the end of the month, Carrie.
Okay, wait. So at the end of the, okay, you started with 40, then you purchased 60 more, then 80 more, then 20 more. So now you have 200 things in inventory.
Available. Yep.
Right. Okay.
Yep.
And you purchased 40 at $62 a piece.
Right.
Okay, and then 60 at 65. So the cost of the units changed over
Right. The
time.
cost of the units are going up. Yeah.
Got it. Okay.
So if you want to know where they got the 16,000 cost of goods, if you want to know where they got the $13,100 cost of goods sold, it would be that 40 times 62 plus
Okay.
60 times 65, that accounts for 100. And then they only needed 50 out of the 80, 50 times 67.
What?
They sold 150 units, right?
Right. Oh, okay, got it. Got it. Okay.
40, 60, and they only needed 50 out of the 80.
Got it. Okay.
So that leaves in their ending inventory 30 times 67.
Okay, and
Plus-
now I got to clarify one thing. Okay, when you're saying, so is this stuff you're purchasing or is this stuff you're selling? So this is what you're selling, right? So you had
This is-
40
this-
units, you're
this is-
selling them for $62 a piece, right?
No, that's what we purchased them for. These are not selling prices. These have nothing to do with sales. This is all cost of sales.
Why does it say sold? Why doesn't it just say cost of goods?
Because cost of goods sold is the cost of the items you sold. We might have sold these units for a lot more than 13,100. For example,
Okay.
40 units times 62, we
Yeah.
might have sold those for $80. We don't know.
Okay,
But in this calculation, we don't need to know that. It's irrelevant.
all right, got it.
Yeah. So FIFO, I mean, I kind of like doing these FIFO things. It's like a little puzzle. What you're doing is you're starting with the first in, first out.
Mhm.
Well, if we sold 150, we know we took 40 from here. We took another 60 from here.
Got
We're
it.
still looking for another 50, okay?
Got it. Right.
And you build your layer that way,
Uh-huh.
okay?
Yeah.
Let's do weighted average. This is super easy. Weighted average. In fact, they just summarize it. Again, we've got the 16,500 and the 250, right? On the available line.
Now we have 250.
Now it's 250. Yeah, they changed the number. It looks
Okay.
like 40, 60, 80, 70,
Yeah.
40. Okay, all right. So they're playing tricks on us. Okay.
Okay.
So the available dollars are 16,500
Yeah.
and the available units are 250. All you do, Carrie, to get the average cost is divide horizontally. 16,500 divided by 250
Yeah.
equals 66.
Got it.
And then you multiply 66 times whatever in the inventory and
Yeah.
66 times the units you sold, okay?
Okay.
And here it is right here. Cost of goods sold, 200 times 66, ending inventory is 66. That adds up to $16,500. In other
Mhm.
words, we're accounting for all of these dollars.
Mhm.
What's available, Carrie, is either still in the inventory, unsold, or we sold it, which means it goes at the cost of goods sold, okay?
Mhm. Okay.
LIFO. LIFO. Here, last in, first out. Last in, first out. Here, we're going to pretend that we're always selling the newest receipts, okay, Carrie?
Uh-huh.
So we're assuming that the sales in the period were made from the most recently purchased goods.
Got it. Mhm.
Justification, I don't care about the justifications. Physical movement in some business actually is last in, first out. Can you think of a business that might have last in, first out?
Maybe like a hardware store.
You're exactly right. That's really good. Yeah. Yeah, like a barrel of screws, right?
Yeah.
You know, somebody opened up a hardware store right after World War II and they filled a 55 drum with galvanized nails.
Mhm.
And people start taking the nails out. When the barrel's like 1/3 full, they just pour new nails on top. So you're
Mhm.
never selling those early ones, right?
Right.
But keep in mind, and I'm sure you understand this, keep in mind that these methods have nothing to do with the actual physical movement of the goods, right?
Right. It's just the
They're
way
just
for them.
just a way to cost them out.
Yeah.
Mesa Produce, I happen to know they use LIFO to do their accounting,
Uh-huh.
but that doesn't mean they never sold the first bunch of bananas they put out in 1950, that they're still there. You get the idea.
Got it.
LIFO, last in, first out. So here we go. LIFO. Which ones did we sell under LIFO? Do you want to try to tell me that, Carrie? We sold, how many did we sell? 150. We're back to 150.
Okay. So the ones that came from the 70 and then
Yep.
the 80.
And
So
that looks, there you go.
so you're accounting for it cost the higher cost, right?
Yes, yes, yes.
What if and if the price were going down, then you still maintain the same system, right?
Yep, yep, same thing. But we're never going to give you a question with falling prices, because
Okay.
in any normal economy, prices need to keep going up, at least reasonably so. You need to have a reasonable small amount of inflation under control. But yeah, all the rules would change if it went the opposite way. What I mean by that is you're going to have a different net income depending on the method you use, okay?
Mhm.
And I'm going to go back to specific ID, even though I don't think specific ID is pretty easy. They simply tell you which items were sold. Okay?
Yeah.
They tell you which items were sold. What kind of company would use specific ID? Big ticket companies, right? A car dealer, When I bought my car a couple of years ago at Perry Lincoln, they didn't say, okay, Bob, thanks for your check. Take any Ford Edge you want off the lot. You don't do it that way, right?
Right.
They have to know the serial number, the VIN number, everything about the engine size,
Mhm.
everything. The specific ID method does match the physical flow, okay?
Mhm.
Boeing Airlines, God forbid a plane crashes, they want
Yeah.
to be able to trace every single part in that plane back to
Right.
the provider to find out what happened, okay?
Mhm. It matches what?
Matches the physical flow, the actual physical flow of the goods,
Okay, got it.
specific ID. So, do some of these problems for homework and hopefully you kind of like doing them a little bit. I mean, I'm not saying this is something you plan an evening of entertainment to do, but it's kind of a nice little puzzle, I think.
Mhm.
Only the specific identification method reflects the flows that match physical flows of goods. Assumed cost flows like FIFO, LIFO, weighted average have nothing to do with the actual physical movement. Any one of these four methods could be used under any set of physical flow conditions.
Okay.
This is an important concept, and I think you understand it already. Goods available for sale is the same for all the methods, right?
Yep.
That's your history. We had 100 at the beginning and we purchased 900 more. Available 900. That's the same for all the methods. Now each method's going to break out that available into the appropriate dollars of cost of goods sold and ending inventory. It's the
Yeah.
ending inventory and cost of goods sold that's going to be different. Gross profit is going to be different. When prices are rising, FIFO results in the largest net income or gross profit. Okay.
Mhm.
That's an important concept to understand. FIFO gives us the highest net income. LIFO gives us the lowest net income. And why is that, Carrie?
Because with LIFO, you're taking the most expensive,
Exactly.
you paid the most for. Okay. Yeah.
Exactly. The cost of sales are going to be higher.
Mhm.
So companies have a choice of these methods. LIFO results in the smallest gross profit, thereby creating the smallest tax liability. So some companies would go for LIFO for that reason, huh?
Mhm.
Others would still go for FIFO because they
Yeah.
want to make a big splash. They want to generate as high an income a number as they can. They want to announce to the world, Boeing set record earnings this period. And to do that, they used every accounting trick they could,
Got it.
legally and ethically to boost earnings.
Mhm.
When selecting an inventory method to be used, the IRS requires the use of the same inventory method for tax and financial reporting. We don't worry about that. The physical flow does not match the flow assumed by the method. And if you're using FIFO, the consistency principle requires that the same accounting methods be followed from period to period. You can't just change on a dime, okay? If
Mhm.
you want to go to LIFO or FIFO, you may have to restate the prior year's financials in order to have consistently stated financial reports, okay?
Yeah. So you can't go from one to another.
Not every month, no.
Oh.
You have to make an announcement that you're going to do it. And then there's all kinds of requirements from the SEC about what you need to do to affect the change. And here's a comparison right here of the four methods.
Yeah.
FIFO, look what the profit is under FIFO,
Right.
4900. Under LIFO, it's only 4630.
Yeah.
Average you would expect to be in between the two, and
Yeah.
specific ID could be whatever. Okay.
Mhm.
So those relationships are important to know. FIFO is a higher net income, assuming prices are going up, and that's all we're assuming. If we wanted to teach about an economy where prices are going down, that would be a disaster. That's called deflation. That's about the worst thing that could happen to an economy.
Yeah.
Perpetual inventory system, a continuous record is maintained for the quantities and cost of goods. We're back on the perpetual again. And look at this, who knew? Much easier to handle with computerized systems. I guess
Sure.
we all know. You bet it is. I'd hate to have a perpetual system like we used to with pencil, you know?
Really?
Yeah, yeah. Back at the W.R. Grace days, yeah. Yeah, I worked for a company called W.R. Grace when I first got out of college for 5 years. And I still remember the long 16, 20 column pages. Students don't even know what I'm talking about. And you
Right.
can't, I don't think you can even buy them anymore. If you go to Office Depot or something, you have to probably order them special. And everything
Yeah.
would be folded on top of each other. All right, Bob, show me the perpetual inventory. You had this giant accordion coming.
Wow. Yeah, I
Done?
know. Yeah, it's everything's, all of that is obsolete now with computers.
Oh, yeah. Yeah. You used to, we had punch cards in those days. Remember the punch
Yeah,
cards? Yeah.
sure.
You turn them into the computer department and then they say, okay, come back tomorrow and we'll have the reports for you.
Yeah.
And then one day I got in trouble with my boss for being lazy. I was filling out all these cards and I thought I would save time by skipping the zeros.
Hmm.
And that was a mistake because when it prints it out, it doesn't show a zero, it shows a space.
Uh-huh.
So my boss was yelling at me that the numbers looked like grandma's teeth. I had all these gaps in them. Guy was all mad. Very nice gentleman, Murray Weitzer, Jewish guy, nice guy. May I tell you a silly story about my life with at that place?
Sure.
My first year there, I made $130 a week, right?
Wow.
So a year goes by, and Murray, my boss, calls me in for my annual review.
Hmm.
And he said, well, Bob, he said, you did pretty good. We're glad to have you here. And as a result, I'm proud to tell you we're going to give you a raise to $140 a week. And I said,
Wow.
Murray, gee, 140. I was really hoping for 160. I said, that's $4 an hour. He says, 160. My goodness, Bob, 160. I said, geez, Murray, you think you could do it? Murray thinks about it. He said, well, okay, Bob, I think that's fine. I'll give you the $160 a week as long as you don't tell anybody. And you know what I replied? Don't
But
worry, Murray. I'm as ashamed of it as you are. Making $4 an hour. College man, $4 an hour. But that
what,
was that was
what year
back in,
was
huh?
that was when?
That would be 1973, roughly 72.
Okay.
It was
Yeah.
back. Now they're showing you the LIFO FIFO in a perpetual system. We don't want to get too heavily into this, but with FIFO, with the perpetual system, you're not waiting until the end of the month to do all the LIFO FIFO stuff. You're doing it as sales are made. Okay.
Yeah.
So here they had 40 and they sold 30. So they sold 30 at 62. That was the oldest price. That left you with 10 there for the next sale. This, I don't think you really have to worry about too much. Okay.
Hmm.
This is just showing you that under the perpetual system, you're going to start driving those cost of sales numbers as the sale is made, not at the end of the month, like we just learned.
Okay.
It's going to come out the same at the end. And here's a principle of conservatism we're getting involved with. When in doubt, a lower asset value and net income measure should be used. When there's a choice, when there's an equal choice between two methods on something, you
Mhm.
must choose the one that has the most negative impact. In other words, you must anticipate losses and never anticipate gains. That's the conservative principle. If an asset increases in value while being held, no formal entry of the gain is made on the books until the asset's sold. And we've
Mhm.
talked about that, right? With the $100,000 land that somebody bought in Santa Barbara in 1960, and it's
Mhm.
now worth 10 million.
Yeah.
Well, it's still going to be $100,000 on your financial statements.
Mm.
No profit until you sell it.
Right.
But if the land turned out to have chemicals under it or something and the land became worthless, then
Mhm.
you would have to recognize that.
I
Okay.
see. Mhm.
And this is part of something called the lower of cost or market. We should never anticipate gains We always anticipate and account for losses, conservatism.
Okay.
Lower of cost or market. If the value of inventory declines while it's being held, the loss has to be recognized. The purpose of lower cost or market is to recognize those losses and report the lower inventory valuation. In other words, you have inventory in stock. You have t-shirts, and you
Mhm.
were selling these t-shirts for $20 a piece, and they
Yeah.
were very popular. But now you're not selling them, and your salespeople are coming back and saying, nobody's buying these t-shirts anymore. They're way out of style. We'll be
Mhm.
lucky to get $10 a piece instead of 20. You have to reduce that inventory value by whatever the lower of cost of the market is. Okay.
Mhm.
So let's take a look at what we're talking about. Cost means dollar amounts calculated. Cost means cost. What did you pay for the goods? Okay.
Mhm.
Market means what would it cost to replace the inventory? It's the price in the market in which goods are purchased by the business, not the price in the market in which goods are normally sold by the business.
Okay.
The method assumes that a decline in the purchase price is accompanied by a decline in the selling price, and thus signals a decline in the value. So let's see here. And this is pretty easy. I don't want to say it's easy, but it's just one rule. Lower of cost or market. You have an item here. You purchased it for $8,000, right?
Yeah.
But now you know it's only worth 7,000.
Mhm.
What are we going to value the inventory at? The 8 or the 7?
7.
Lower of cost or market. Here we bought something for 9, but the market is still giving us 10,000 for them. 9. We go with the lower number.
Got it.
Same thing here. So our correct inventory value is $22,500. Okay,
Mhm.
not the 23,500 under market, nor the 24,000 under the purchase price. Okay.
Okay.
Two ways to calculate lower of cost to market. Apply to the total inventory. The lower of all items at their cost or all items at their market value. I'm not going to go over this much here. What they're talking about is aggregate. Companies have a lot of part numbers, okay?
Mhm.
They don't, the IRS and proper accounting doesn't expect you to know the exact price of every single item. But overall, in the aggregate, you know that this type of screw is no longer selling at what you thought it was. And
Mhm.
you can make an entry on that basis. So it can be applied to the total inventory in aggregate or to each item. Assume we use the total inventory method. The journal entry needed to reduce the inventory to 23,500. That's going to be an expense. So we went from 24,500 to 23,500. Would you agree? 24,500 to 22,500.
At 22,500. Yeah.
Yeah, the difference here, I think they have a mistake.
Well, that was what the market was.
Yes, yes.
So wait,
The lo-
can you go back to that other slide? That one. So they're saying end of period market value is 23,500.
Yes, but at the market value,
Right.
but we don't pick up all those market. We pick up the lower. So we pick up 1,000 here. That's $1,000 reduction, and here's 500. So the difference is really $1,500, not 500. That's a mistake. This should say 1,500. You see where we got the 1,500?
Yeah.
8 minus 7 is 1. That's a $1,000 adjustment. No adjustment here. And then we
But
have another $500 adjustment here.
it looks like they're comparing the recorded purchase cost 24,000 with the end of period market value 23,500. That's where the $500 difference
Yeah,
is.
but that's not that might be true mathematically. But they shouldn't be doing that. That doesn't.
Right. They should be comparing the 24 with the 22,500, right?
Yes, they should be compared. They should be selecting one of these these 3 pairs of numbers,
Yeah.
and that becomes your new inventory. So I say the number's 1,500. They say 500. But I guess the important thing is look at your journal entry. You're going to debit loss on write down of inventory and credit merchandise inventory.
Okay.
So that goes right down to your net income. That's a loss.
Dang. Okay,
Estimate. Now, here's where we're going to stop this lesson because we don't go into teaching the gross profit and retail inventory methods. Basically, what we're doing here is a company over the period of months knows that their gross profit's been around 40%. They're allowed to simply take that 40% and apply it to the next month's sales to come up with their cost of goods sold
mhm,
and gross profit. So we don't really teach that here. It's not a normal method, not used that much, I don't think. And there we go.
okay,
There we go. Not too bad. Well, the key thing here is have fun with the FIFO and the LIFO.
okay, I will.
All right. Any questions?
No, I don't have any questions at this
All
point.
right. Well, I'll take a break. I got 2 more classes after this.
Okay, well, enjoy that.
Got to keep the voice under control here.
Right.
These mellifluous tones, honed by the mean streets of Newark, New Jersey. Okay, we'll talk to you later, Carrie.
Okay, thanks, Bob.
Bye-bye.
Bye.